In this presentation, we will discuss Roth IRAs, Roth Individual Retirement Accounts, Roth IRAs. This will be a long presentation, so if you would like to jump to relevant parts within it, take a look at the description below, which will have links to those relevant components, as well as a description of what will be included in them. Much of this information can be found in publication 590A. There will be a link to the publication on the IRS website in the description below. In this presentation, we will introduce Roth IRAs, Roth Individual Retirement Accounts, as opposed to traditional individual retirement accounts. Note that if we don't have the word Roth in front of an IRA or individual retirement account, we are traditionally thinking about the traditional individual retirement account as opposed to the Roth individual retirement account. So as we go forward, we're going to be comparing and contrasting the Roth individual retirement account. And as you think about the Roth individual retirement account, we want to keep the individual retirement account, normal, traditional account in mind, so we have some context to think about what the Roth is, how it differs. This information can be found in publication 590A. Introduction. Regardless of your age, you may be able to establish and make non-deductible contributions to an individual retirement plan called a Roth IRA. Note the component here of non-deductible contributions. Contributions are not reported. You don't report Roth IRA contributions on your return. So let's compare and contrast that. If we think about the tax return, then the Roth IRAs aren't going to be reported. So we think about them in terms of taxes and tax planning. And usually when we think about things in terms of taxes and tax planning, we're thinking things that will show up on the 1040 in some place. But the Roth IRA is one of those items that is tax planning that will not show up on the Form 1040 at the point in time that the money is distributed to it or contributed into the Roth IRA. And that, of course, is different from the traditional IRA. So the traditional IRA, we think of the 1040. This is an example of the 1040. We would have our $30,000 here. We have $30,000 of income. And we generally think of putting money into the IRA so that we can reduce the income, thereby decreasing the amount of tax we would owe, and we would then result in a difference between the total income and the adjusted gross income. That would then be reported on Schedule 1. We would have our deduction here. That would be a traditional IRA. The Roth IRA doesn't have that. The Roth IRA, we're not going to have that. We could put that same $5,500 into a Roth IRA and it would look like this. We would have no adjustment, no difference between that would be due to the IRA. There's no difference in any case in anything in this example. But if we put $5,500 into the Roth, then we have the same amount reported on line 6 and line 7. We no longer have the schedule reporting the adjustment to income, the adjustment between line 6 and 7, the adjustment for adjusted gross income. So you might ask, well, why would I put money into a Roth IRA? The whole point is for me to get a deduction on the tax return. I'm taking all this money, I'm putting it into this restricted account. I would only do that if I got some type of tax benefit. And that is true because the Roth IRA will also be restricted in some way, and you don't have the type of benefit that you have here. But if you think about the full scope of what happens in a traditional IRA, then we do get taxed at the point of retirement. And that's kind of burdensome because when at the point of retirement, we're probably at a point in our life where we might have been withholding our entire lives and whatnot, and all of the withholding's been taken out of our paycheck for us the entire time. And then at the point of retirement, we're going to have to think about the money that we pull out and how much of that we're going to have to pay in taxes because it'll be taxable in the traditional IRA. The Roth IRA makes it a little bit easier at the point of retirement because we didn't get the benefit at the front end, and therefore when we pull the money out, it's going to be tax-free at the point in time that we pull the money out at the end. And that's going to be a big benefit because, of course, then we can pull money out and not have to think about, well, how much of this money do I have to pull out and how much is it going to affect the increase in my taxes at the point of retirement. And so that's going to be the benefit. You don't see it on the taxes, but you don't see it on the taxes as a deduction when you put it into the Roth IRA, but you also don't see it on the taxes as income when you pull it out of the Roth IRA at the point in time of retirement. And not reporting it at that point is not reporting income, which is not paying taxes on it at that point in time of distribution, as opposed to the traditional IRA, which is nice. So the Roth IRA, the concept of the Roth IRA then would typically be You might be in a situation, the traditional IRA concept would typically be that, well, if I'm making a lot of money now, my tax bracket would probably be higher at this point in time than it would be in retirement, maybe. And therefore, I want to get the deduction now. I also want to get the deduction early if possible, because I would rather get the deduction today than in the future. And then when I pull the money out in the future, maybe I won't be earning as much because it won't be in the prime of my earning life possibly, and I'll have deferred the money. On the Roth, however, the Roth contemplation might say, hey, I'm only making, like right here, I'm making 30,000. This person's making 30,000, putting 5,500 into the Roth at this point in time would save taxes of whatever the tax rate would be, which is currently around 11 to 12% at that 30,000 of income. Maybe I would be drawing more money out of that at the end of my at retirement. So it might be better for me just to pay the taxes right now, because I'm not going to be paying too much taxes given the rate is 11 or 12%, and maybe the rate will be higher. Maybe I'll be drawing more money out and be at a higher tax bracket at the point in time I take the money out. So maybe I would be better off in a Roth situation where I pay the tax now, I let it grow over time, and then I take the money out and I don't have to pay at retirement. The other thing that you kind of want to think about too is between the Roth and the traditional is that it'd be nice to have some money in both, because I want to take the tax benefit right now to have the tax benefit, and I'd also like to at retirement have some money that is tax free when I take it out, and some money possibly that I have to pay taxes on because I got a benefit on it now. And in that format, you can imagine a situation if I was retired and I want to live on $100,000 a year. If I take it all out of a traditional IRA account or something equivalent to it, on which I have to pay taxes, then I got to pay taxes at like $100,000. The tax rate's going to be fairly high, as compared to if I take 50 out of a traditional type of retirement account and 50 out of some type of Roth account that's not taxable, I can live off of 100, only paying taxes on 50. So some type of comparison or some type of equality or some type of distribution between a Roth and a traditional IRA may be beneficial in retirement years, as well give you more options for how to pull the money out and how to pay less taxes and live well at the distribution side of things. We'll continue to talk about a few more of these items as we consider and discuss the components of the Roth IRA in future presentations. In this presentation, we will discuss the question of what is a Roth IRA. This information can be found in publication 590A. A Roth IRA is an individual retirement plan that, except as explained in this chapter, is subject to the rules that apply to a traditional IRA defined next. It can be either an account or an annuity. Individual retirement accounts and annuities are described in Chapter 1 under how can a traditional IRA be opened. So we've discussed in prior presentations what it is to be a traditional IRA. If you don't have a concept of the traditional IRA, then you want to go back and think about the traditional IRA, because the traditional IRA is going to be the point that we start at, and then we discuss the differences from the Roth IRA. So you want to consider, okay, what's a traditional IRA? They're both going to be types of retirement accounts. They're both incentives for us to save for retirement. And the traditional IRA is the traditional incentive and therefore has the overarching characteristics of what an individual retirement account is. The Roth retirement account then has some different components to it, which will be specific and advantageous within specific circumstances. As we've seen in prior presentations, the traditional IRA will typically be reported on the 1040 as we put money into it. There'll be a difference between line 6 and line 7, and the adjusted gross income will be lowered typically if we qualify for that with the traditional IRA, and that will then be reported on the Schedule 1 showing that difference, that contribution. Not the case for the Roth IRA. We do get tax benefits for the Roth IRA, but the benefit is not in the reporting of the deduction on the Form 1040 at the point in time we contribute to the Roth IRA. To be a Roth IRA, the account or annuity must be designated as a Roth IRA when it is opened. A deemed IRA can be a Roth IRA, but neither a SEP IRA nor a SIMPLE IRA can be designated as a Roth IRA. So when we open up the IRA account, note that when we think about an IRA, we typically have the same kind of requirements that we typically would think of with an individual retirement account, with a traditional individual retirement account. We're thinking about incentives for retirement. And so you can just think of, well, where would I put my money at retirement if I'm getting incentivized to save money for retirement? That's what the government wants me to do. That's why they're giving us tax breaks. How would I typically do that? Well, I'd go bury it, I'd money in the backyard and then dig it up. No, we're going to put it in the bank. We're going to put it into some type of financial institution, probably stocks and bonds in some way. Those are going to be the traditional types of investments, not the only types of investment, but the traditional types of investments. As we do so, we're going to set up the IRA. We set up our IRA account, which typically will be something like some type of savings account, stocks and bonds, investment type of accounts, similar to what would be there if we didn't put the money into an IRA and we were just saving for retirement anyways without any kind of incentive from the government. Similar type of accounts, we can set up the types of investment accounts whether or not they're under the umbrella of an IRA. Putting them under basically the component of an IRA then actually gives us restrictions on our money. So we can have the same type of savings account or investment in stocks and bonds that would not be in an IRA would not then be restricted. In other words, we can take it out if we want to without penalties or anything like that. Why would we then restrict it by putting it into the same type of investment account, but then calling it an IRA where they penalize us for taking our own money back out because we get a tax incentive on it? So just realize that that's going to be the main component of it. As we put it into these assets, then we'll basically put it under the umbrella, and we need to label it a Roth IRA as we put it into the account. Because the Roth IRA, then the financial institution will regulate the account as a Roth IRA and be able to account for the gains as we gain money on it. Hopefully, unlike if it wasn't in any type of IRA account, we would not have to pay taxes on the gains, and therefore it's going to accumulate upwards, and then at the point of distribution, they can properly record the distribution in accordance with the rules of the Roth IRA. So therefore, when we set up our accounts, we have to make sure that we're setting up in terms of a Roth IRA. Now, typically, where would you go for that? The bank can typically help with that. Financial institutions, normal type of institutions with normal type of investments, normal type of financial investments, banks, savings accounts, financial institutions, stocks and bonds can often help with the setting up of IRAs, Roth IRA type accounts as we do so. Unlike a traditional IRA, you can't deduct contributions to a Roth IRA. So that's going to be the big difference, of course. The big difference, can't deduct. We're not here to deduct this contribution. So again, why would I do it? We're going to do it because there could be many situations. And note, the IRS was incentivizing people to put money away for retirement. And you can see that the traditional IRA, in some cases, you might say, well, it's not really given a whole lot of incentive, because if, for example, in this example, the tax is fairly low at the income, so it doesn't help a whole lot to put the money in possibly at this point in time as it would in other conditions. So the IRS wants to say, well, what happens in those conditions where, the tax, it's not a big incentive. They'd rather just pay the tax right now possibly. Well, what if we then, under those circumstances, under certain circumstances, set it up so that when you put the money into the Roth IRA instead of the traditional IRA, you don't get the benefit here at front at the point in time that you put the money in, but you get the gain or increase in value of the money over time. And then when you take the money out, you don't have to pay taxes on it. So you get a more future-oriented planning, still a tax benefit, just not a tax benefit at the point in time that the money's put in place. One that most people don't see as well, because we see the thing that's now and that's on the tax return. We see the change in the tax return. And a Roth IRA is much more behind the scenes, because what happens is we don't report the benefit as we put it in, and we also don't see the bad thing when we take it out, which would be having to pay taxes on the income when we take it out. We don't see that either, because we don't include the income in our tax return, in that case on the income line, which means we don't pay tax on the distribution at the point of retirement, hopefully, if we can keep it in that long. So that's the benefit of it. Back to the text. But if you satisfy the requirements, qualified distributions discussed in Chapter 2 of Publication 590B are tax-free. So that's going to be the benefit. The distributions at the point of retirement typically will be not taxed, and that's the difference between the Roth and the traditional typically being taxed at the point of distribution at the point of retirement. Contributions can be made to your Roth IRA after you reach age 70 and a half. Again, unlike the traditional IRA. The traditional IRA basically says, hey, we're going to give you a tax deduction here at the point in time you put the money in. It's basically a deferral, and we expect you to take the money out at some point of the IRA account, of your investment, of your savings accounts, of your stocks and bonds. You need to take it out at some point before you die, hopefully, because we want to tax you before you die. And then when you take it out, then we take your money, right? That's going to be the deal for the traditional IRA. So that means that you have to worry about paying taxes when you take the money out. And then you could die and inherit it. I mean, you can inherit it. I don't want to scare anyone on that. But just note that the inheritance rules could differ too, based on it being the fact that it's going to be taxable on the distribution side. So that means that they also are going to say that they don't typically want people to put more money in at the point of retirement and take a deduction when the minimum distributions are happening for a traditional IRA. But the Roth IRA doesn't have that same kind of limitation because they're not required to make the distribution. The IRS isn't concerned about the distribution as much for a Roth IRA because you're not going to be paying any income taxes on it anyways at the point of distribution. It's tax-free. It shouldn't have any distribution tax. So you can keep on actually putting money in and not have that cap as you do with the traditional at the 70 and a half, which is usually when the required distributions happen. We can still put in money into the Roth IRA. And you can leave amounts in your Roth IRA as long as you live. And again, a huge benefit because note, at the point of retirement, if you put all your money into an individual retirement account or some type of retirement account, and let's say you don't need it, you don't even need the money right now, you're living on enough, you have enough money, the IRS will force us to take the money out in some type of format, in some, not all at once, but force us to have required distributions at 70 and a half, and we'll have to basically pay taxes on that. What we don't want to have happen is the required distributions to be higher than what we need, because then we're having to pay taxes on more money than we need to be distributed out to us. And so it'd be nice to have some money in some accounts that we don't need to take out, and so that we can basically monitor or have some control over the amount of money that we're spending and the amount of money that we're going to be paying taxes on. And so to do that, it would be nice to have some money in a traditional IRA that because we get the benefit now, and when they may force us to take it out in the future and we have to pay taxes, and then have some of our money somewhere else, possibly including a Roth IRA, where we're not as restricted to take the money out. We're not required to take the money out. And if we do decide to take the money out, we're not taxed on it either. So we have a lot more leeway at the point of retirement with that money, which is nice. A traditional IRA is any IRA that isn't a Roth IRA or simple IRA. Traditional IRAs are discussed in Chapter 1. So when you think about the IRAs, typically you think traditional IRA, that's what you have to go through the traditional IRA and think about all the characteristics of a traditional IRA, and then think about the Roth as the kind of the new thing, the change thing, the one with a little bit twisted of rules that would be more advantageous in certain circumstances and certain situations. When can a Roth IRA be opened? You can open a Roth IRA at any time. However, the time for making contributions for any year is limited. See when you can make contributions later under can you contribute to the Roth IRA. So in other words, you can put money into the Roth basically at any time you want to put the money in. You just need to know when you're going to basically assign that contribution or to what year you're assigning that contribution to. And there are going to be restrictions to the amount that we can contribute into the Roth IRA as well. So we want to make sure that we're clear about when we put the money in terms of what year we're going to be applying that contribution to, so that we're in compliance with the contribution limits. And we'll talk more about that in future presentations. In this presentation, we will discuss the question of, can you contribute to a Roth IRA? This information can be found in publication 590A. Generally, you can contribute to a Roth IRA if you have taxable compensation, defined later, and your modified AGI, defined later, is less than $199,000 for married filing jointly or qualified widow, widower, $135,000 for single head of household or married filing separately, and you didn't live with your spouse at any time during the year, and $10,000 for married filing separately, and you lived with your spouse at any time during the year. Let's break this down. So generally, you can contribute to a Roth IRA if you have taxable compensation. So we'll talk about what the taxable compensation is, but obviously when we're thinking about that, we're thinking about a type of income. So if we consider the 1040, we're thinking about income up top. Now, not all income will be considered compensation with relation to the IRA, or whether we qualify to be able to contribute to an IRA. But obviously, we're talking about income type of items, and typically what will qualify will, of course, generally be the wages or W-2 income. So then we have the adjusted gross income or modified adjusted gross income. What does that mean? So we have to have a modified adjusted gross income in accordance with these levels. So the adjusted gross income is on line 7. So line 7 is the adjusted gross income. Notice it's not modified on line 7. It's just the adjusted gross income. Whenever you see this term modified, or most of the time when you see the term modified, it's basically taking the adjusted gross income, line 7, then making adjustments to it with relation to the specific item that we are looking at. In this case, of course, the qualifications for a Roth IRA. Usually line 7 is going to be basically modified under kind of unusual kind of circumstances that might not apply to everyone, and therefore line 7 adjusted gross income is often the number that we use many times when you see the term modified. In other words, modified only happens for certain tax papers, possibly a very slim or smaller majority or minority of taxpayers, and therefore line 7 can typically be used. Notice that we're talking about an income limitation, so line 7 is basically the same in this tax return as line 6, which is total income, but the above the line deductions, or now we can call them Schedule 1 deductions, could affect the adjusted gross income. So for whatever reason, the tax code usually uses the AGI adjusted gross income to figure any of the income limitations. Obviously, as income goes up, then tax benefits typically go away. So as we earn more money, tax benefits possibly go down in accordance with some type of phase-out type of activity here. So then we have the AGI. So the modified AGI defined later is less than. So if we have AGI less than $199,000 for married filing jointly or qualified widow, widower. So if we are filing joint, we're married, filing joint, then we have that highest limitation. We're good up to $199,000 for married filing jointly. Not bad. Then we have the $135,000 for single head of household or married filing separately, and you didn't live with your spouse at any time during the year. So note here that we have this married. This is a little bit unusual, where we have the single head of household often grouped together. So we're going to say married is this item. Then if you had income of $135,000 or less, then you should be okay to contribute to the Roth IRA. For single taxpayers, head of household, that's kind of the norm, or married filing separately, and if you didn't live with your spouse at any time during the year. So that's kind of a weird special kind of condition. Usually, the tax code kind of pulls away any kind of benefits for married filing separately. They typically consider that if you're married, you file married, and you can't go back and file head of household or single when you're married typically. And that if you file married filing separately, you kind of lose a lot of benefits oftentimes. But here they're saying that if you're filing married filing separately and you didn't live with your spouse at any time during the year, then you have this limit, which is better, far better than the next item, which is you'd have to have less than $10,000 for married filing separately and lived with your spouse at any time during the year. So if you're married and you're basically legit married and everything's going and you're living together, then if you choose to file separately, the tax code has a severe limitation in this area, as they do with many. But they do have this exception, which basically means that you're kind of separated in some context or according to the tax code, if you're married and you haven't lived with each other for the entire year, and they give some leeway with this particular area for married filing separately in those cases, which is interesting. Back to the text. Is there an age limit for contributions? Contributions can be made to your Roth IRA regardless of your age. Unlike the traditional IRA, there's not that age limitation, which is nice. So you can keep contributing into the Roth IRA. Can you contribute to a Roth IRA for your spouse? You can contribute to a Roth IRA for your spouse provided the contributions satisfy the K. Bailey Hutchinson spousal IRA limit discussed in Chapter 1 under how much can be contributed. So we discussed that difference in the prior presentation, so you can take a look at that. It's the K. Bailey Hutchinson spousal IRA limit. Typically, we think of the IRA contributions kind of separately and go through the rules for the husband and wife or the two spouses, even though they're filing joint return. But then there's kind of this exception, and that exception is under the K. Bailey Hutchinson spousal IRA limit that we took a look at in prior presentations, that if you have questions on, you can go back there and take a look at it. You file jointly and your modified AGI is less than the $199,000, which of course is the AGI limitation or modified AGI limitation. Compensation. Compensation includes wages, salaries, tips, professional fees, bonuses, and other amounts received for providing personal services. It also includes commission, self-employment income, non-taxable combat pay, military differential pay, and taxable alimony and separate maintenance payments. For more information, see what is compensation under who can open a traditional IRA. So we went through these items basically in Chapter 1 as well. What is considered compensation? Note that we have to have some compensation. That is going to be up here in the top area of the Form 1040. Normally, compensation would be the wages, salaries, tips, and etc. in line 1. What's not generally in there is going to be passive type of income most of the time. So when you're thinking compensation, we're not typically thinking passive type of income. Things on like dividends or interest, where we're just getting money from our investments, are more passive types of incomes that typically would not oftentimes be included in the compensation. Modified AGI or adjusted gross income. Your modified AGI or adjusted gross income for Roth IRA purposes is your adjusted gross income AGI as shown on your return with some adjustments. Use worksheet 2.1 to determine your modified AGI. So we had some limitations based on, as your AGI goes up, if it goes past certain level, then there could be some restrictions, your modified AGI. And as we said, the AGI starts on line 7. So there's the AGI on line 7. And then we're going to have some modifications to it based on the specifics of the code related to whatever it is we're talking about in this case. Roth IRAs. Typically, the modifications oftentimes don't relate to a lot of taxpayers. There might be specific situations where they had to make a modification for certain circumstances for certain areas. Caution: don't subtract conversion income when figuring your other AGI adjusted gross income based phase-outs and taxable income, such as your deduction for medical and dental expenses. Subtract them from AGI, adjusted gross income, only for the purpose of figuring your modified AGI or for Roth IRA purposes. In this presentation, we'll discuss the question of how much can be contributed to a Roth IRA. This information can be found in publication 590A. The contribution limit for Roth IRAs generally depends on whether contributions are made only to Roth IRAs or to both traditional IRAs and Roth IRAs. So we have a situation, did we put money just into the Roth IRA? And we're considering how much can we put in typically per year. So we're thinking about a year's time period. How much can we put into the Roth IRA? And we've got a couple different things to think about. How much could we put in if we're talking about just the Roth IRA? How does the Roth IRA interplay or play with other types of retirement type accounts, including a traditional type of IRA and Roth IRAs only? If contributions are made only to Roth IRAs, your contribution limit generally is the lesser of $5,500 or $6,500 if you are age 50 or older, or your taxable compensation. So this is going to be similar to the traditional IRA, where we had the limit. So if you have no other things going on, if you're taking a look at your tax return and you're saying, here's my tax return, I'm making $30,000, I didn't put any money into a traditional IRA, or I don't want to because my income is relatively low, my tax rate's relatively low, I'd rather just put it into a Roth IRA because I think that might be more beneficial, then the limit is going to be similar to that which we saw for the traditional IRA, $5,500 for the most people, $6,500 for anybody over 50, and or your taxable compensation. So your taxable compensation, you have the limit of the amount of taxable compensation you have as well. So you could be limited if your taxable compensation is less than the amount that you want to contribute. However, if your modified AGI, adjusted gross income, is above a certain amount, your contribution limit may be reduced as explained later under contribution limit deduction. So notice we had some limitations with the AGI. If our AGI is high enough, then we might have some limits. So if line 7, if that goes over some of those limits, you'll note that it could start to phase out at some point in time. So if it's too high, then we may not be able to contribute. If it's somewhere within the range, then we might have to lower the amount of contribution that we can make based on the AGI limitations. Roth IRAs and traditional IRAs. If contributions are made to both Roth IRA and traditional IRA established for your benefit, your contribution limit for both IRAs generally is the same as your limit would be if contributions were made to Roth IRAs, but then reduced by all contributions for the year to all IRAs other than Roth IRAs. Let's go through that one more time. If contributions are made to both Roth IRAs and traditional IRAs established for your benefit, your contribution limit for Roth IRAs generally is the same as your limit would be if contributions were made only to Roth IRAs. So it's going to be the same there, however, but then reduced by all contributions for the year to all IRAs other than Roth IRAs. So in other words, if we think about the traditional IRAs, they typically have similar limits if there were no other type of activity, which would be that 5,500 or 6,500 if over 50. So now we're considering the Roth IRA. If we weren't contributing to any other IRA, then you would have the similar limits for the Roth, 5,500 or 6,500. And they're saying here that if we have contributions, what's the contribution limit if we have money into another IRA? In essence, they're saying it would be the 5,500 minus or reduced by all contributions for the year to all IRAs other than the Roth IRA. So if we put in 3,000 into a traditional IRA minus the 3,000, then you'd get the 2,500. So in essence, between the two of them, you'd have 5,500 in there between the Roth IRA and the traditional IRA in that case. Employer contributions under SEP or simple IRA plans don't affect this limit. So that's going to be important to note. Notice the limit isn't affected by the SEP or the simple IRAs. And typically those would be plans set up by a small employer. So if there was an employer, you're working for someone and they don't have like a 401k, but they have a smaller company and they might just set up a type of retirement plan, which would be something like a SEP or a simple IRA plan. So this means that your contribution limit is the lesser of 5,500, 6,500 if you are age 50 or older, minus all contributions other than employer contributions under the SEP or simple plan for the year to all IRAs other than Roth IRAs, or your taxable compensation minus all contributions other than employer contributions under the SEP or simple IRA plan for the year to all IRAs other than Roth IRAs. So as you consider this, note that most people don't have access to the SEP or the simple IRA. So if you're not dealing with the SEP or simple IRA, then obviously you can basically eliminate that exception. If it is there, that might be a good benefit for you. But for most people, probably not something they're dealing with. So you can kind of take that out of the description here, and it'll be more simplified to consider. If you are dealing with the SEP or the simple, then take those into consideration. It could be beneficial. However, if your modified AGI is above a certain amount, your contribution limit may be reduced as explained later under contribution limit reduced. So if our AGI is getting high, getting to those limits, then we may have some type of reduced amount that we can contribute to the Roth IRA due to AGI income type limitations. Simplified employee pension SEPs and savings incentive match plans for employees, SIMPLEs, are discussed in publication 560. So if you're dealing with a SEP as either an employee or an employer, you want to take a look at the details related to the SEP and the SIMPLE. You can go to publication 560, take a look at the IRS website at irs.gov, type in pub or publication 560. Repayment of reservist distributions. You can repay qualified reservist distributions even if the repayments would cause your total contributions to the Roth IRA to be more than the general limit on contributions. However, the total repayments can't be more than the amount of your distribution. Note, if you make repayments of qualified reservist distributions to a Roth IRA, increase your basis in the Roth IRA by the amount of the repayment. For more information, see qualified reservist payment under how much can be contributed in Chapter 1. In this presentation, we will take a look at a table for the effect of modified AGI or adjusted gross income on a Roth IRA contribution. This information can be found in publication 590A. So we have table 2.1. This is going to be the effect of modified AGI on Roth IRA contributions. In other words, how much can we put into the Roth IRA? Are we limited with regards to our income? As our income goes up, can we put less into or contribute to a Roth IRA? And the AGI then is going to be a number that we think about on the tax return. We're talking about line 7 on the tax return, which in essence is going to be our income. It's going to have the above the line deductions or the Schedule 1 type of deductions to it to get to the adjusted gross income, modified adjusted gross income being slightly modified from line 7 in particular situations with regard specifically to the calculation we have here for the IRA or Roth IRA contribution. So in essence, income type limitation, this table shows whether your contributions to a Roth IRA is affected by the amount of your modified adjusted gross income, modified AGI. How it's going to work, we're going to have the headers here. If you have taxable compensation and your filing status is, then we'll list the filing status, and your modified AGI is, then we'll have this item here, then the consequences. That'll be the format of the table. Let's go through it. First item, if you have taxable compensation and your filing status is married filing jointly or qualified widow or widower, and your modified AGI, adjusted gross income, is less than $189,000, then you can contribute up to $5,500 or $6,500 if you are age 50 or older, as explained under how much can you contribute. So in that case, there's no problem. We don't have a problem here. You're at 189, married filing jointly. If you're under that, then the maximum of $5,500 or $6,500 if 50 or older will then apply, and we're good to go. Next item, if you have taxable compensation and your filing status is married filing jointly and your modified AGI, adjusted gross income, is at least 189, the lower limit, but less than 199, well, now we're in an area of confusion here, because then the amount you can contribute is reduced as explained under contribution limit reduced. So this is going to be a scenario where it's a bit more confusing because you can still contribute, but it's going to be reduced in some format. This is where you'd like to have some tax planning if possible, possibly have tax software to help with that calculation, although you can use the worksheet in order to figure it as well. But if you're in this range, you can typically still contribute. Note that you may want to figure things out at the end of the year. This might be something that you can have the money, have it ready, but then at the end of the year, you do some tax planning for it and then decide based on that information how much you can then contribute into a Roth IRA. Note, again, it's not going to have an effect on the return that you're making for the current year, because it's not going to be something that'll be deducted like the other or standard or normal IRA would, but we could use the tax return in order to help to see if we can still put money into a Roth IRA. So it's nice to get the tax return done on time and go through those last minute kind of questions, which include oftentimes, can we put money into an IRA? Can we put money into a Roth IRA? Back to the next item. If you have taxable compensation, your married status is married filing joint or widow or qualified widow or widower, and you're over the $199,000, then you can't contribute to a Roth IRA. So you're over the limit. AGI limitations, your AGI, you make too much money. Can't put any money into the Roth IRA in that case. Of course, that doesn't mean you still don't put money into a retirement. You still put money aside for retirement at that point in time. It's just you can't put it into a Roth IRA and get the benefits of the Roth IRA for that. If you have taxable compensation and your filing status is married filing separately and you lived with your spouse at any time during the year, in other words, there's no kind of special exception where you're separated, where you may have not lived with your spouse the whole year, then possibly there would be an exception, then this is kind of the worst filing status with regard to things like the IRA. There's often going to be exceptions to some of the benefits that could be there in the tax code with regard to the filing status of married filing separately, because the tax code generally would regard or think that the married couple would file married filing joint. So, and your modified gross income, AGI, is 0. If it's 0, then you can contribute up to $5,500, $6,500 if you are age 50 or older. So that's a pretty low limit. If you're married filing separate and you have more than 0 but less than 10,000, again, pretty low on the modified AGI, the amount you can contribute is reduced as explained under the contribution limit. So then you can take a look at the contribution limit and try to figure that out. Something under, of course, the 5,500 or the 6,005. And then if your modified AGI is 10,000 or more, you can't contribute into the Roth IRA. So again, pretty large limitations for married filing separately. If you have taxable compensation and your filing status is single, head of household, or married filing separately, and you didn't live with your spouse at any time during the year, so they have that special rule now where, okay, you're married filing separately, but maybe you're pretty much separated if you didn't live with your spouse, and then that falls into this category, and your modified AGI is less than 120,000, then you can contribute up to $5,500, $6,500 if you are age 50 or older, as explained under how much can be contributed earlier. If you're single, head of household, or married filing separately and you didn't live with your spouse during the year, then, and your modified AGI is at least 120, but less than 135, now we're in the range, we're in that range. The amount you can contribute is reduced as explained under contribution limit reduction. Reduced earlier. So now you're going to have to pay something less. Again, we'll have to figure whatever that might be. And then if we have income of or modified AGI of 135,000 or more, then you can't contribute to a Roth IRA, and so you're over the limit at that point. In this presentation, we will discuss the questions of when can you make contributions and what if you contribute too much with regards to a Roth IRA. This information can be found in publication 590A. When can you make contributions? You can make contributions to a Roth IRA for a year at any time during the year or by the due date of your return for that year, not including extensions. So that's going to be similar to the traditional IRA, similar type of restrictions. Note that in essence, we can put money into the Roth IRA any time, but we want to make sure that we apply it to the proper year so that we know we are in compliance with whatever requirements there are, including the maximum type of contribution and how much we can contribute per year. And so we have a similar type of scenario with the traditional IRA. Even though it's not affecting the tax return, we still are limited by that modified AGI, which is determined by the tax return. So we still have to think about that tax planning in order to put the money in. So we could put the money in if it's 2018 and we want to apply it to 2018 and we actually invested it in 2018 into a Roth IRA. Pretty straightforward, not too much trouble, easy to do. However, oftentimes we might wait till the end of the year because we might actually want to prepare our taxes, especially if there's a limit on how much we can contribute. So then you have up until the time that the tax return is due, typically April 15th of the following year. So if we're talking 2018, it would be April 15th, 2019. In that case, then, you make the contribution to the IRA, the Roth IRA, in 2019, and you want to make sure that you tie it to the 2018 return. Make sure that the contribution is made for or with regard to 2018 so there's no confusion, which obviously if the applying to the years 2018 and the payment was made in 2019, it can get a little confusing. So when you make the payment in 2019, make sure that you are aware of the timing difference, that it's actually applied to the tax year of 2018, and back to the text. Tip: you can make contributions for 2018 by the due date, not excluding extensions. So note, you can't make an extension and say, hey, I'm going to pay it later at some later point in time. So the extension doesn't help with the tax planning. The IRS already gives us a nice benefit of saying you don't have to make the payment in 2018. You can wait until the tax return is due, and that's a huge benefit. And of course, that's going to save a lot of problems because, again, a lot of people might not know how much they can contribute until the tax return is prepared. But they don't give the extension time period to still apply the payment for 2018. You can see how that would get kind of confusing because then you'd be making payments late into 2019 for 2018. So they only give up to the date of the return for the original due date, not including that extension amount. Back to the text. For filing your 2018 return, this means that most people can make contributions for 2018 by April 15th of 2019. What if you contribute too much? So now we talked about the limitations. We talked about how much can put in to the Roth IRA. What happens if, it's just all we're doing is putting money into basically a savings account under the umbrella of an IRA, and the person that is managing the account doesn't really do our taxes. So how would they know what are modified AGI? They don't. So what if we put in too much? What happens? That could quite easily happen. Back to the text. A 6% excise tax applies to any excess contributions to a Roth IRA. So you have a 6% tax because, again, the IRS does not want to allow excess contributions because then they'll grow. I mean, they'll get the benefits of growing tax-free, and then they're not even taxed when you take the money out. And the IRS, obviously doesn't want that, so they're going to say that there should be a 6% tax on any excess contributions into the Roth IRA. Back to the text. Excess contributions, these are contributions to your Roth IRAs for a year that equals the total of 1. Amounts contributed for the tax year to your Roth IRAs other than amounts properly and timely rolled over from a Roth IRA or properly converted from a traditional IRA or rolled over from a qualified retirement plan as described later that are more than your contribution limit for the year explained earlier under how much can be contributed, plus any excess contributions for a preceding year reduced by the total of A, any distributions out of your Roth IRAs for the year, plus B, your contribution limit for the year minus your contributions to all your IRAs for the year. Withdrawal and excess contributions. For purposes of determining excess contributions, any contributions that is withdrawn on or before the due date, excluding extensions for filing your tax return for the year, is treated as amount not contributed. So here's the scenario. We put the max in, possibly 5,500, and we couldn't put that much in. We could only put, 5,000 in. We put 500 too much in because we were restricted due to our AGI limitation, let's say. Well, what do we do at this point in time? Well, if the return hasn't been filed, then we take the 500 out before that point in time. So we can do that. We can say, okay, look, I'm not getting the benefit from it. Nothing, my mistake. I'll just take the 500 out and then we're good. Now note that if you have the 500 in there, and so if you do that before the due date, then that should be good. Obviously the 500 that you put in could have had some income on it as well, and you'll have to deal with the fact that you could have had earnings on it. Probably not a lot if you took it out pretty quickly, but that could be a situation as well. Back to the text. This treatment only applies if any earnings on the contributions are also withdrawn. So say we put in 500 more than we should have. We got to take out the 500 and the earnings on the 500. Okay, so the earnings are considered earned and received in the year the excess contribution was made. So we made the contribution, let's say in the middle of the year, we put in 500 too much. We didn't know, but now we know at the end of the year because we did our tax returns and we have a limit of how much we can put in. So we took the 500 out, but we earned some income on it as well, on that 500 that we put too much in, and we have to take that out as well. So we take that out and we have to include that as income, because if it was in the Roth IRA, we wouldn't have to include it as income, but because it's under the Roth IRA. But now that we take it out, then we have to include that in income. Back to the text. If you timely filed your 2018 tax return without withdrawing a contribution that you made in 2018, you can still have a contribution returned to you within 6 months of the due date of your 2018 tax return, excluding extensions. If you do file an amended return, so now we're saying, well, what happens if I filed the return? Well, then you could amend basically the return. If you do file an amended return with failed pursuant to 301-91002 written on the top, report any related earnings on the amended return and include an explanation of the withdrawal. So note this you'd have to amend the return, and note that the only thing that would change, because the fact that you made a contribution to a Roth IRA doesn't even affect the tax return. We're not getting any benefit from it. The only thing that would change is that we might have a little bit of interest. In our case, of that $500, that interest is something that we would have to report. But it's also something that we can be clear with the IRS and be honest with them and make sure that there's no confusion about our Roth IRA by saying, hey, look, we made an excess contribution, we took it out, we've amended that. The excess contribution and the contribution's not on the return, but we just want to let you know we took it out and we reported the income related to it here on the amended return back to the text. Make any other necessary changes on the amended return. Applying excess contributions. If contributions to your Roth IRA for a year were more than the limit, you can apply the excess contributions in 1 year to a later year if the contributions for that later year are less than the maximum allowed for that year. In this presentation, we will discuss the question of, can you move amounts into a Roth IRA? This information can be found in publication 590A. You may be able to convert amounts from either a traditional SEP or SIMPLE IRA into a Roth IRA. So note, this is going to be a kind of an unusual type of transaction here, because we've talked about before the concept of transferring from one type of traditional type of retirement account to another, which makes sense because as the money is in the account, if it's a retirement account, it's acting in a similar fashion once it's in the retirement account. In other words, many of the differences between different types of retirement accounts are in when the money gets put into the account, how much can be put into the account. Once it's in the account, for tax purposes, it's treated in a similar way in a traditional type of IRA, it being accumulating upwards and being taxed at the point in time it's taken out. Now, if we go from an IRA to a Roth IRA and transferring from something like a traditional to something like a Roth, then that's a bit more unusual, because now we're talking about two different types of things, really. They're similar in nature in that they're retirement accounts, but they act a bit differently for the taxes. The Roth IRA then not having a tax consequence at the beginning, at the point of contribution, and not having a tax consequent at the end, meaning we don't have to include it typically in income when we draw it out. So notice there are two different behaviors. So now the question is, well, is it possible for us to transfer from one type of account to another? Back to the text. You may be able to roll over amounts from a qualified retirement plan to a Roth IRA. You may be able to recharacterize, and that's basically what we're doing here, because we're saying, hey, it was in this type of retirement type of account, like more of a traditional type of retirement account, and now we're recharacterizing it. We're changing the character, its nature, now to a Roth type of IRA, which is a different animal. So now we're recharacterizing. So recharacterized contributions made to one IRA as having been made directly to a different IRA. You can roll amounts over from a designated Roth account or from one Roth IRA to another Roth IRA. So clearly you can roll over from a Roth IRA to a Roth IRA. That would seem to make sense, because of course that would be two things that are similar in nature, and therefore the rollover should be something that would be okay, or you would think that there would be less problems there. So you just need to be in compliance with the rollover from a Roth to a Roth. If you're rolling over from something that's not a Roth, it's more of a traditional, to a Roth like a SEP or a SIMPLE IRA, then you want to make sure you're in compliance with that conversion, because there's basically a conversion or recharacterization process. So conversions. You can convert a traditional IRA to a Roth IRA. The conversion is treated as a rollover regardless of the conversion method used. So if we're going from a traditional to a Roth, it's going to be a rollover regardless of the conversion method used. Most of the rules for rollovers described in Chapter 1 under rollover from one IRA to another apply to these rollovers. So when you do the rollover, you want to go through and make sure you're in accordance with the presentation we took a look at earlier from the rollover from one IRA to another. They apply, but now we have the added wrinkle of one being traditional and the other being the Roth. So now we're going to think about the things that are different from rolling over from one IRA to another when they're not different in nature. Back to the text. However, the 1-year waiting period doesn't apply. Conversion methods. You can convert amounts from a traditional IRA to a Roth IRA in any of the following 3 ways. 1, or first way, rollover. You can receive a distribution from a traditional IRA and roll it over, contribute it to the Roth IRA within 60 days after the distribution. So again, we have these 2 types of accounts. We got the traditional and we got the Roth. We got the traditional, we've got the Roth. Here's where the money is, there's where we want it to go, and here's us. We're the taxpayer down here. Now, it would be nice, it's probably the safest thing to transfer directly and not get our hands on it, because anytime we get our hands on the money, the IRS is going to get a little bit more, suspicious about the transaction. But we can do that. We can take the money out, a rollover, take the money, and then put it back into the Roth. So we take it out of the traditional, we put it back into the Roth. If we do so in compliance within the 60-day time period, then our goal is for it not to count as a distribution and then a contribution. That's not what it is. It's a rollover. So what we want, so when we take the money out of the traditional, if it was a distribution, then typically it would be taxed and possibly penalized. We don't want that. We want to be able to roll it over, meaning we took the money out, but yeah, we put it right back in to another retirement type of account. It just happened to be a Roth type of account this time, rather than the normal or traditional IRA. Next item, trustee to trustee transfer. You can direct the trustee of the traditional IRA to transfer an amount from the traditional IRA to the trustee of the Roth IRA. And that's probably the safer way to go typically, because there's less confusion between that transfers possibly. So we can say it goes from one directly to the other, and the third party, us, that are just directing the transaction. We're not actually receiving the money and then putting it back into another one. Back to the text. Same trustee transfer. If the trustee of the traditional IRA also maintains the Roth IRA, you can direct the trustee to transfer an amount from the traditional IRA to the Roth IRA. And that's probably fairly common as well. If we have some tax planning situation where we are saying, look, I just want to make this traditional IRA a Roth IRA, then it's not going between 2 different trustees. The whole, or the financial institutions, the bank possibly, it's just not going to 2 different trustees. It's just basically recharacterizing or transferring the funds from the traditional to a Roth within. And so that would also be fairly straightforward, more of a straightforward transaction than taking the money out and then redistributing it back in the rollover type situation. Same trustee. Conversions made with the same trustee can be made by redesignating the traditional IRA as a Roth IRA rather than opening a new account or issuing a new contract. So in that situation, it would be nice if we could just say, hey, this was a traditional IRA and we basically want to convert it, in essence, to a Roth IRA. The term used, redesignated the traditional IRA to a Roth IRA. Income. You must include in your gross income distributions from the traditional IRA that you would have had to include in income if you hadn't converted them into a Roth IRA. These amounts are normally included in income on your return for the year that you converted them from a traditional IRA to a Roth IRA. So in other words, we have to basically treat part of the conversion as, in essence, it was basically a distribution. So if we've got the traditional IRA and we've got the Roth IRA, and we're putting the money from one to the other, basically, as we convert it, we have to recognize that the money in the traditional IRA, when you take the money out, if it was to be distributed, we would have to record it as income. Typically, we would have to record it as income at the point in time it was distributed, and if we distributed it early, we'd be penalized on it. So in essence, we're still thinking we might have to record it in income because we got the benefit of not recording it in income when we put it into the traditional IRA. And what we're trying to do is recharacterize it. So what we'd really like to do is recharacterize it and possibly still have to pay taxes on the amount that is income, but because we're recharacterizing it, but not have to pay the 10% penalty for the early distribution within that recharacterization. So notice as we go through this process, we may still have the income. We may not have to be able to roll it over and not have to have any income, not have to have an effect on the tax return, possibly increasing the taxes due to an increase in the income. However, we may be able to recharacterize it and avoid the 10% penalty. So if we're in a situation and we have a low amount of income this year and we have a lot of money in possibly a traditional IRA, then we might say, hey, I would like to take advantage of the fact that I have a low tax rate, possibly take money out of the traditional IRA when I have a lower tax rate. And if I have to claim income on it, that's fine if I can avoid the penalty, and then put it possibly into a Roth IRA so that at the point of distribution at retirement, when my tax rate might be higher, then I don't have to pay taxes at that point of distribution. I have more ability to do tax planning at that time. Back to the text. Caution. If you must include any amount in your gross income, you may have to increase your withholdings or make estimated tax payments. See publication 505, Tax Withholdings and Earning Estimated Tax. So obviously, if we have to include anything in income, just like when we pull money out of an IRA at retirement, it's going to increase our gross income, and therefore we could end up owing more money. We have to basically plan for that, and the IRS wants their money beforehand. So we might have to make some type of estimated payment even before we file the tax return if that's part of our plan. If we expect for our income to be increased for whatever reason, in this case with regard to the conversion process from the Roth to the traditional. Back to the text. More information. For more information on conversions, see Converting from any traditional IRA into a Roth in Chapter 1. So we covered this basically in more detail in Chapter 1, so you can go back to a prior presentation when we were talking about the traditional IRAs and look at that conversion process up there. Rollover from an employer's plan into a Roth IRA. You can roll over into a Roth IRA all or part of an eligible rollover distribution you received from your or your deceased spouse's employer's qualified pension, profit sharing, or stock bonus plan, including a 401k plan, annuity plan, tax sheltered annuity plan, section 403B plan, or the governmental deferred compensation plan, a section 457 plan. Any amount rolled over is subject to the same rules for converting a traditional IRA into a Roth IRA. See Converting from any traditional IRA into a Roth IRA in Chapter 1. So we took a look at that in the traditional IRA presentation. So you can go back up there. Of course, we're talking about a situation here where there's some overlap between the traditional and the Roth as we think about these kind of conversion topics. Back to the text. Also, the rollover contribution must meet the rollover requirements that apply to the specific type of retirement plan. Rollover methods. You can roll over amounts from a qualified retirement plan to a Roth IRA in one of the following ways. Rollover. You can receive a distribution from a qualified retirement plan and roll it over, contribute to a Roth IRA within 60 days after the distribution. Since the distribution is paid directly to you, the payee generally must withhold 20% of it. So note we have to deal with this withholding process here because, of course, we're talking about a withholding. Or if we're talking about something that deals with an employer, then they typically have to be in accordance with the withholding process. Back to the text. For rules about making a rollover of a plan loan offset, including a qualified plan loan offset, see time limit for making rollover contributions in Chapter 1. Direct rollover option. And if this is possible, it might be an easier process to have kind of the direct rollover option. Back to the text. Your employer's qualified plan must give you the option to have any part of an eligible rollover distribution paid directly to a Roth IRA. Generally, no tax is withheld from any part of the designated distribution that is directly paid to the trustee of the Roth IRA. So again, this is kind of a situation that if you've got one account over here and it's restricted in some way because it's some type of retirement account, and we're putting it into another account, and then here's us down here. So you can see if this rollover option 1, notice over here we're talking about someone who's restricted or is being managed or has regulations that they need to comply with regard to the government regulating possibly like employees. So you can see how the IRS would be skeptical if they take the money and give it to the employee. Then the IRS is going to say, I want you to do your typical withholding of the 20% just to make sure that we get the 20% on that. But if you make a direct transfer from one account that's already restricted to another, the IRS, and without us taking the money, the IRS might be more able to say, hey, I trust that transfer because it's not going out of a restricted account into the hands of the taxpayer. It's going to go from one basically type of IRA type of account that's under the trustees, and we can pressure them to another one, and it's not going to the taxpayer. And therefore, typically, if you do that, you may not have to deal with this 20% withholding type of issue. Back to the text, rollover by non-spouse beneficiary. If you are a designated beneficiary other than a surviving spouse of a deceased employee, you can roll over all or part of an eligible rollover distribution from one of the types of plans listed above into a Roth IRA. You must make the rollover by a direct trustee-to-trustee transfer into an inherited IRA. You will determine your required minimum distribution in years after you make the rollover based on whether the employee died before his or her required beginning date for taking distributions from the plan. For more information, you can see distributions after the employee's death under Tax on Excess Accumulation in Pub or Publication 575. Income. You must include in your gross income distributions from a qualified retirement plan that you would have had to include in income if you hadn't rolled them over into the Roth IRA. So again, we would have to think about the income that possibly could be recorded because we have the similar kind of conversion type of situation going from a plan that it might be more of a traditional type of plan and converting it in some way to more of a Roth type of plan, and therefore it could result in income with that process. Back to the text. You don't include in gross income any part of the distribution from a qualified retirement plan that is a return of basis after tax contributions to the plan that was taxable to you when paid. So there could be, remember when we think about the traditional type of plans, there could be part of the money that was put into it and we didn't get a tax benefit at the point in time it was contributed. And we could have some of the money that was put into it that we did get a tax benefit when we put it in, meaning we paid less taxes when we put it in by not including it in income at the point in time we put it in, and therefore the plan is that when we take it out, we would have to pay taxes on it. So that part of the money that we got a benefit from on the distribution would typically be some part that we might have to pay or include in income and pay taxes on it as income at that point that we roll it over or transfer it to a Roth type of IRA. But any type of money that we didn't get the benefit of decreasing our income that's in the retirement account, then typically you would think that we wouldn't have to pay income taxes on that because we didn't get the deduction or reduction in the front while we put the money in, and therefore when we take the money out, you would think it wouldn't be taxable at that point. Back to the text. These amounts are normally included in income on your return for the year of rollover from the qualified employer plan to a Roth IRA. Caution: if you must include any amount in your gross income, you may have to increase your withholdings or make estimated tax payments. See Publication 505, Tax Withholding and Estimated Tax. So if you're considering rolling over from a traditional type of IRA, or you're leaving work, or you're transferring something from a retirement account into a Roth IRA, then you could result in income as that transfer happens. You want to do tax planning for that, and then you might have to owe money based on the fact that your income would be higher, and therefore pay some type of estimated payments to avoid any late payment penalties or anything like that on that process. Back to the text. For more information on eligible rollover distributions, qualified retirement plans, and withholdings, see rollover from employer's plan into an IRA in Chapter 1.